Recursion Pharmaceuticals, ticker RXRX, is currently trading at $5.73, down about 0.35% on the day. The immediate expectation for many looking at that fractional move is that this is just another high-beta, speculative biotech stock getting knocked around by the broader market's minor indecision. It's easy to dismiss as background noise, but the reality of today's slight dip, when you look closer, is less about broad market fear and more about a very specific, quiet, institutional rebalancing that's happening just below the surface of the order book. The volume is deceptively average, but the type of block trades being executed suggests larger funds are methodically trimming positions, not retail investors on their Robinhood app panicking. This isn't a story about the AI hype train today. It's a story about sophisticated portfolio management and a subtle but important shift in sentiment. Look, the prevailing narrative for Recursion has been, for a long time, quite straightforward. This is a company at the center of using artificial intelligence and machine learning to map biology and discover new drugs faster, cheaper, and more effectively than traditional slow-moving lab methods. When tech sentiment is hot, and especially when a name like Nvidia stock is soaring, Recursion catches a major updraft. Investors see it as a leveraged play on the next application of AI, assuming that the correlation to the tech sector is all that matters. The expectation is that you're buying a tech company that just happens to be in the healthcare space. But here's the reality check. That correlation is a double-edged sword, and lately it's been cutting the wrong way. The market is starting to demand more than just a good story and a loose association with a hot sector. It's aggressively shifting its focus from what could you do with AI to what are you doing with it. The real driver for Recursion's valuation isn't the AI narrative anymore. It is, and always should have been, the clinical trial pipeline and, critically, the cash burn rate. The expectation is that their big-name partnerships, like the significant collaborations with Bayer or Roche's Genentech, will shield them from financial realities. The reality is that those partnerships have very long timelines, and the market's patience for pre-revenue companies is wearing incredibly thin in this high-interest rate environment. People who got into online investing thinking this was a quick flip, something they could trade on their SoFi trading platform like a meme stock, are suddenly finding themselves accidental long-term holders of a highly speculative, complex, and slow-moving research and development position. Let's look at the actual chart movement over the last few weeks, because it tells this story perfectly. We saw that sharp spike mid-month, an attempt to break above the key resistance level around the $6.50 mark. That attempt failed, and it wasn't just a technical failure. It coincided with lukewarm data from a competitor in the AI drug discovery space, which immediately cast a shadow over the entire sector. Today's slow drift down to 573 is a direct continuation of that failed breakout. The stock is now consolidating and testing a key support level right around 550. If it breaks decisively below that level, we could see a very rapid flush down to the 200-day moving average. Volume is critical here. Today's volume is tracking just under the 50-day average. This isn't capitulation selling, it's apathy. It's a slow bleed. And in many ways, apathy is worse than panic, because it means new buyers aren't being tempted to step in and replace the sellers who are quietly heading for the exits. This is where Fidelity brokerage accounts and the data tools on the Interactive Brokers platform show their true value. If you look at the 13F filings from the last complete quarter, we saw a very mixed and telling bag of institutional activity. Some big tech-focused funds like ARK added to their positions, buying the AI story. But at the same time, several highly respected, healthcare-dedicated specialist funds actually trimmed their positions. This tells me that tech investors are buying the narrative, but the pharma specialists, the ones who actually know how to read clinical data, are still deeply skeptical about the timeline and the probability of clinical translation. This is the central conflict in the stock. When you use your Fidelity mobile app or SoFi active investing account to buy shares, you are placing a bet on which one of those narratives wins. Are you buying a fast-moving tech company or a slow-moving drug company? The institutional money is completely split on the answer, and that's why the stock is stuck in this volatile, sideways churn. And you simply cannot ignore the macroeconomic environment. This isn't Tesla stock or Apple stock, companies that are generating tens of billions in free cash flow. Recursion is a pre-revenue, research-intensive biotech. It survives by raising capital. With interest rates where they are, the cost of that capital is painfully high. The risk-free rate on a simple treasury bond is attractive, which means investors are demanding a much higher potential return to justify the enormous risk of holding a speculative asset like RXRX. This macro pressure is a constant gravitational pull on the stock. Every time a Fed governor sounds even remotely hawkish, stocks like Recursion get hit first and hardest. It's why so many self-investing individuals are being advised to diversify, perhaps by using automated systems like Schwab Intelligent Portfolios or sticking to broad market Fidelity ETFs instead of taking on this kind of single stock risk. This isn't a safe investment, it's a speculation. Their last quarterly update was the very definition of a mixed report. The expectation from the investing sites was for a clear, concise update on their progression of their clinical pipeline. The reality was a report that focused heavily on platform development, data generation, and the expansion of their operation system, which is all great foundational work, but the market wanted clinical milestones. The market wanted proof. Furthermore, the cash burn was slightly higher than analysts had anticipated. Again, in this environment, that's a major red flag. Let's be perfectly clear. They have a solid cash runway. They are not going bankrupt tomorrow or next year. But the perception of that cash burn is what dictates the stock ceiling. They must at some point show that their expensive AI platform is not just a high-cost research tool, but a true efficiency engine that lowers the cost and time of development. We are all still waiting for that definitive proof. People managing their long-term Fidelity Wealth Management or Fidelity IRAs are looking for that specific, quantifiable progress before they'll allocate serious, sticky capital to this name. So, for those who might be new to this entire story, what does Recursion actually do? The expectation is simple. They use AI to find new drugs. The reality is far more complex and, frankly, more interesting. Recursion is building what it calls the Recursion Operating System. They use a massive setup of advanced robotics, cellular imaging, and machine learning to conduct millions of biological experiments on human cells every week. They are, in effect, creating a massive, proprietary, multi-dimensional map of human biology. They then apply their machine learning algorithms to this map to identify novel relationships between genes, diseases, and potential drug compounds. The whole idea is to industrialize the process of drug discovery. Instead of a single scientist at a bench having one hypothesis and spending a year testing it, Recursion's platform tests millions of hypotheses simultaneously. They have their own internal pipeline of drugs focused on areas like oncology, inflammation, and rare diseases. But their bigger bet, and the source of their current validation, is on partnerships. They've signed those major collaborations, most notably with Bayer and Roche's Genentech, where those big pharma companies pay Recursion to use its platform to find new drug targets or candidates for their own pipelines. This model generates some upfront upfront cash and potential milestone payments, which help offset the burn. But the real life-changing upside everyone is betting on is in the future royalties, if a drug discovered on this platform actually makes it to market and becomes a blockbuster. That is the long-term lottery ticket that investors are holding. That's why it's such a popular name for online investing. The story is incredibly compelling. It's not as straightforward as buying Nvidia stock because you know they sell chips. It's a bet on a process. When you use the interactive brokers tools, you can see the option chain for RXRX is incredibly active, which shows just how much speculation there is on both the upside and the downside. The interactive brokers account is built for traders who understand and can manage this kind of volatility, whereas a beginner using Robinhood fractional shares might get badly shaken out by a 10% intraday swing. This isn't a stable Fidelity mutual fund, it's a single high-stakes bet